Thanks very much, and welcome back. It is Chuck Malamut's time here with us every Tuesday morning at 8:05, and this program for basically 25 years, presented by Chuck Malamut, a financial advisor at Morgan Stanley. The information, views, opinions expressed on this program are those of Chuck, do not necessarily reflect those of Morgan Stanley or its affiliates. They are current as of the date of today's broadcast and are subject to change without notice. Neither the information provided nor any opinion expressed herein constitutes a solicitation for the purchase of or sale of any security. This presentation is for informational purposes only. Morgan Stanley Smith Barney, member, SIPC. Hey, Chuck, welcome, and a lot to talk about this morning.
Good morning, Harry.
Yes, sir. Would it be fair to say that China is affecting markets as we speak?
You know, Harry, it's interesting in the fact that when we looked at, if we walked in yesterday, I guess is the best way to put it, coming in Monday morning with the Chinese market down, I believe it was over 8%, it was actually pretty encouraging to understand that what happened here in the U.S. yesterday, even though it was a down day and we've had 5 out of 6 trading days have been down, and we're now at 6 month lows in the S&P, the Dow in particular. It is still somewhat encouraging to look at what has happened on a comparative basis in China. And, the government in China is doing absolutely everything they can to support the market to the point where they're trying to, just basically, prop that market. And what happened on Monday morning or Sunday night when we were sleeping is that those measures were not effective. And when you really take a close look as to what happened since 2014, a lot of individual investors are now afforded the opportunity to buy into the Chinese market if you're a Chinese citizen. Unfortunately, as it turns out, you think about, where we were, 30, 40 years ago as far as, the general public not having any real inclination or understanding of how a market, particularly an equity market, works. Being able to buy on margin and being able to buy significantly larger amounts on a percentage basis on margin compared to what we have here with our rules and regulation, unfortunately, it basically sent that market up significantly higher. Sort of, I hate to use a term like a rocket ship, but when you look at the chart, that's exactly what it looks like.
Was China,
and now we're going through a lot of retracement.
Was there any evidence that China actually agrees with capitalism, or was this just because they knew that it would spawn, an increase in their market?
Well, look, Harry, I mean, I think after you look at yesterday's trade, Monday's trade, and last night as we were sleeping, the market moved down further and did stage somewhat of a comeback, even though it was down, I believe, 60 points for the day. I consider somewhat of victory. Putting that all into place, the Shanghai or the Chinese market, as of yesterday, was still up 20% year to date. And so you put that into perspective, it is the leading marketplace as far as total return. But if you bought at the wrong time, you could be down anywhere from 50 to 60% of your capital. Unfortunately, what has happened here, because most of the general public in China is not terribly sophisticated, they have not been educated as to how a market works. Instead of buying a broad diversification of equities, they pile into one or two positions, able to buy on margin. And at the end of the day, when you get a margin call here in the U.S., if you get a margin call, you get sold out. Chances are you might still have some value in your account if let's say, for instance, if you margined up to the max and then had margin calls, you still have some net equity. Unfortunately, the way the rules are written in China, Harry, there's been some cases that I've read about where you have negative net equity and now are forced not only to sell, but you need to come with additional capital. So, when you look at what is happening there on a comparative basis, there's somewhat a disconnect compared to what's going on with the rest of the world, because you would think if you're down 8% going into into the U.S. opening bell, that you would be down you'd be down significantly. And we pretty much held our own, and the futures this morning are pointing to a higher opening. So I think we are somewhat decoupling, at least from that particular market at this point in time.
I jumped in with China fast and furious, so we'll come back to international things a little bit later and talk about Greece. Anything further by way of market update?
Well, Harry, look, if you take a look at where we are today, we've had a tale of multiple markets in the last almost 7 months. The S&P up 2%. By far, the U.S. domestic equity markets are trailing, or the laggards of the group, compared to Europe, compared to the Italian market, to the German market, the Japanese market. But we've had these fits and starts, and with a fair amount of volatility. It's I mentioned, I believe it was last week or the week before, that volatility seemed to subside somewhat, but now it's back, and evidenced in last week alone. So we made recent highs a couple weeks ago. Last week, the Dow Jones was down almost 3%. The S&P was down over 2%, and the Nasdaq lost over 2%. The 10-year and the Fed is meeting this week, and all eyes are back on the Fed, and everyone seems to believe that you're going to get more of the same. Maybe some indication, if the reports are correct or not correct, if the reports are there to showing a stronger economy, that you're going to get your first hike in the fall. I'm
raising my hand to ask the Professor Malamut to call on me, because my position from the beginning has been the Fed. I'm not even going to call it a mistake, because I know why they're doing it. I just don't necessarily agree with it or why they're doing it. There's nothing about our markets right now, and you could look at any type of example. We're negative, we're contracting in terms of GDP. You talked about volatility. I don't know why there's still this desire to, and it's kind of cagey the way it's being done. I think it's been very articulate the way it's been done, because threading that needle, tiny little eye hole, and threading that needle in it is very tricky without a magnifying glass sometimes. I don't see anything about our economy that the Fed should enthusiastically be talking about raising interest rates.
Well, Harry, there are a couple points that I think the Fed is looking at. So let's kind of break it down here a little bit. The latest weekly jobs claims reading that we see shows that the number has now dropped to about 255,000. That's basically the lowest level we've seen since 1973. Now, I know.
Chuck's looking at my eyes.
I know the next statement. So
right, because after 4 weeks they take you out of that number.
So maybe that
you would never be able to turn in numbers like this. I would never be able to go to Mike Rubel and say, "Hey, look at these numbers." I mean, you would never be able to. Why do they get away with this, Chuck? You just reported that, knowing that I cannot allow that. I mean, after 4 weeks, they take you out of the numbers.
Harry, I barely got it. I barely rolled it off my tongue, and I saw your eyes
because it's
popping.
So dishonest. Not from you. This is a dishonest number.
It is what it is, and you're saying, well, what does the Fed do? So this is one of the I guess we'll call it price points that they're going to look at. So here's what else they're going to look at. While we have chatted for a number of weeks now about corporate earnings, it seems as if here's what's happening. About 35% of the S&P 500 companies that have reported as of now with their second quarter earnings, the good news is that earnings are beating expectations by almost 6%. But remember, those numbers have been moved down from as we got at the end of the first quarter. Now, that is an above average pace that we are now seeing since we've been in since we came out of the Great Recession. However, and this is where I think the Fed maybe needs to take a real hard look, and I do agree with you that do you increase? When do you increase, and to what magnitude, and how often?
I think it is intellectually honest to say this is the most unhealthy 5.4 or 5.5%, whatever it is. Could it even be 5.3 now? I forget. But wherever it is, it's somewhere at or near 5.5. This is the most unhealthy 5.5%, or in other words, almost 95% employment market in American history.
So here's... I don't, Harry. I do not disagree with you on that.
So the Fed takes that into consideration.
I think that's going to be one of the things the Fed's going to look at. I think the other item that the Fed's going to look at we've talked about this, and you see it every morning. I saw it this morning as I'm watching that show that I'm obligated to watch, and it's not a 3-letter
NPR?
Right. I do not watch that, Harry, just so you know.
Your favorite station, okay.
But here's what happened. Revenues, for a lot of the companies that are reporting, we're stuck. We're in neutral. We're not going anywhere. And if we are doing anything, on average, your expectations are being increased by a very, very small margins, less than 1%. It's actually 0.3%. So you would think, when you look at the industrials in particular, that particular sector, they've been obviously hit by these lower energy prices. As you started our discussion this morning, now slower growth in China. And as a result, we have earnings that are not where they need to be. So maybe the Fed is going to not increase rates in September. I mean,
that's what I think.
I have heard a number of reports, and again, you think about, we've heard this for 5+ years that interest rates are moving higher. So if you sat on the sidelines sitting in cash or in very, very short-term maturities, think about the time cost, what you lost by not having your money and I'll say intermediate corporates, good quality corporates earning anywhere from 3%, 4%, even 5%. So now I guess a lot of investors are saying, well, the Fed's going to move. The Fed's going to move. I'm going to wait. A lot of indications are September. There's a number of folks in the December camp, and then you have a few that are basically saying they're not moving in 2015.
Yeah, I hope not. Not based on the lack of health of the overall economy and the fact that the unemployment numbers are cooked. And hopefully the Fed can look at the U16 or whatever that report is called, look at true work participation rate, the lowest in American recorded history. How can we have 95% employment and simultaneously have the lowest work participation rate in history? That is a recipe for disaster. He is Chuck Malamut, the official financial advisor to Hurley in the Morning. We're going to step aside for just a couple of minutes. Chuck will be with us until 8:45 this morning. At 8:50, we are expecting the award-winning weather machine herself from Fox News and from the Fox Business Channel, Janice Dean, in a Hurley in the Morning VIP special event. We'll be back with Chuck and more important information in just a few minutes. And by the way, to turn to go to the person that I trust unconditionally with all of your financial planning needs. That's everything that you could possibly think about in life: college building, retirement, vacation planning, nest egg, rainy day, whatever you want to plan for. Turn to Chuck, tell him that I sent you. And Chuck heads up his team, the Malamut Group, at Morgan Stanley's Northfield office, 609-383-2010. Welcome back. It's our official financial advisor, Chuck Malamut, presenting the important issues of the day relative to your financial matters. Chuck was talking about his usual Tuesday morning market update. You did feather in the Fed, but is there anything else about the Fed that you want to share? I'm going to predict they will not, that the language will not change at all, and it will still be this ambiguous.
You're talking for this week.
Yes.
Yeah, so what we seem to think is the Fed's going to probably say they're going to reiterate the ongoing progress with respect to economic growth, which you and a lot of listeners disagree with. And they're going to suggest potentially that interest rates increases remains sort of on the horizon. Looking out and saying, okay, what does the future bring. We don't think they're going to offer a specific time frame. They haven't previously done it, but September. When you sort of poll the group of strategists, most everyone seems to believe that September seems to be the most likely starting point. For the first rate hike.
You know me, Chuck, and I know you, and we've been doing this for 25 years together. We cannot stay in the zero rate interest environment for much longer, forever. It's been 7 years. It's unprecedented as it is. However, I would hate to see the decision be based upon intellectually dishonest information by making the employment market look healthy when it's not.
Well, Harry, I think it's the employment market, it's the consumer, it's manufacturing. I mean, there are a lot of reports out there.
All right, so the employment market, you have to almost lie to say it's good. What was the other thing you said? Manufacturing. Do you think that that's gangbusters right now? I would say not. And consumer spending was the third thing you said. And right now people are leery to spend. In fact, I think markets are surprised that people aren't spending more because these phony numbers would lead you to believe there's a healthier economy and that people would spend freely, but they're not. So if those are some of the key sort of indices, then you wouldn't raise interest rates in this environment, if we're being honest.
One of the things that the equity markets they don't like confusion. And we might be at this point in time, and it seems as if even though you've had a fair amount of volatility, day in and day out, that equities seem to be stuck here. And if you think about we're in a trading range, Harry. We really haven't domestically, other than the NASDAQ, which is the best performing market of the three. We're sitting here waiting with all the uncertainties coming, from the Fed regarding their policy, and you think about it, putting China aside for a minute. Europe. I mean, everybody. I mean, I can't tell you how many clients we chat with, Harry, that have a tremendous distaste for investing in Europe. And I'm not sure exactly why, but if you take a look at what has happened, over the last year or so, the European markets, particularly the Euro Stoxx 50, has done a reasonably good job compared to what we have here domestically.
Chuck, in terms, if we're done in terms of that portion of your program, in terms of mergers and acquisitions, is there anything noteworthy?
Harry, it seems as if every day, and particularly Monday, there was another deal yesterday, Allergan and Teva. In certain spaces within the market, you think about. Let's kind of take a step back here for a second. We've chatted about virtually no revenue growth on the top line with a lot of companies. So with that being said, and you've squeezed out most of your expenses. I mean, you think about when we were in 08 and 09 and 2010, there was a lot of the earnings were a result of reducing expenditures because of the labor force. You had too many people working. You're able to consolidate positions. You had technology enhancement. So you squeezed out a lot of those expense numbers. So now you're stuck. Now we are, as not stuck in the sense that earnings for the most part are ever increasing quarter over quarter, but the revenue number's not there. So how do you get it done?
How do you get it done?
You have a good, quality company that has been operating. They have a lot of cash on the balance sheets oftentimes. So what we are seeing so far, coming out of the financial crisis, we had a lot of activity in 2014, and right now, year to date, what we are seeing in 2015 is that we are probably going to outpace everything that has happened since 2007, that peak that we hit. So you hit the peak in 07, the market goes the wrong way in 08. So what's the average investor think about? If we stop that discussion right there and said, okay, M&A activity is up fairly significant or up significantly, year over year. We are at these multi-high levels. What would you think, Harry, is the next thing that would happen?
In terms of companies merging?
No, in terms of the equity market. Would you be somewhat suspicious saying, well, geez, okay, in 2007, the market, it peaked. Remember prior to that, back in early 2000.
Hey, look, contrarian would head north or south and everybody else would see it as positive. Let me ask you a basic question about mergers and acquisitions, because there's a lot of reasons that they happen. I think that most people just think about one company that's stronger, one company that's not as strong. The company that's not as strong gets absorbed by the company that is stronger. They lose their identity, and then they just become part of this one company. But sometimes it's two healthy companies that decide strategically that they can be better as one.
You're absolutely right. And what happens is you're able to, once you merge those companies, when you begin to look at your expense side, there are a number of areas. First, come to mind. First thing you think about is HR. Oftentimes you have an HR department, division in company X, HR division in company Y.
Everything, purchasing,
so
administration, everything.
You're able to wring out some more of these expenses, and at the same time, if you do not have an overlap on the revenue side, you're able to enhance revenue. So what we're seeing now is that,
and you've consolidated competition many times.
Yeah,
and you have a healthier one company.
And a perfect case in point, I think that kind of answers it is you look at the airline industry. For so many years, the consumer had a lot of choices, and what is happening now, the most recently, and I happened to be looking just the other day at taking a flight out of Philadelphia, and two carriers, American/U.S. Airways, and Delta. And on the fringe, all those other carriers have sort of fallen by the wayside. So, interesting case in point, U.S. Airways and American, the stronger company of the two happen to be U.S. Airways. But because of the name recognition, they are dropping the U.S. Airways name and are going to go under the guise of American Airlines. I think very, very interesting concept. So now as you're booking...
They bought the name.
Well, they bought more than they bought.
I get it,
they bought a lot.
But they picked the name.
But they did elect to keep that name. But I think what is happening in that particular industry is the fact that you have very, very few choices, and now there's all kinds of discussions out there about potentially, price gouging and fixing and other like. So, but that's a real good example. I mean that, and in the healthcare industry. You're seeing a lot of it, and also in technology as well.
Brief time out. We're going to come right back. I am not saying this because I'm not like Chuck. I'm not a financial expert. I'm not qualified to have the conversation at Chuck's level, but I do know politics, and I do know the way the government works. And when this was announced, I believe you're going to see some massive federal charges that could involve criminal charges. Sometimes they make a financial settlement and it's just all handled, and sometimes they actually bring full-blown criminal charges. Expect to hear a whole lot more about this down the road just a little bit. Halftime, Chuck Malamut will be here for the next at least 15 minutes, Janice Dean in 19 minutes. Welcome back, 35 minutes past the hour. It is Chuck Malamut from Morgan Stanley. He heads up his own group, the Malamut Group. And again, for all of your financial planning needs, give Chuck and his team a call, 609-383-2010. Chuck, how are we doing?
So let's finish on the M&A, because we got a little sidetracked, and then we went to break. So if you take a look, Harry, there are some real fundamental differences from where we were in 2007 to where we are today. As we chatted about, earnings are pretty much at a standstill. Growth, as we know it, ran into some headwinds last year. There wasn't a lot of growth, and that kind of persisted in the first two quarters of this year. So, you think about, the S&P and the Dow. We've had a lot of volatility, and it hasn't been a great year so far. So corporations now are looking for that mechanism, for ways to figure out to generate that much needed top line growth. And in the absence of what I'll refer to as you always talk about the lack of economic growth.
Amen.
So if you can't grow, your business through sales, increased sales or revenues, you have to find another way. So what we're seeing is that we've continued with a lot of these mergers. It seems as if a day doesn't go by where we don't see another one. So I think this is going to continue, and in all likelihood, we are not where we were in 2007. That is
Chuck,
for sure.
Mergers and acquisitions doesn't always bring about great news, but I would say, generally speaking, it is typically, at least in the beginning, positively received because the end result is typically a stronger company.
What used to happen is that the company that was being announced as being acquired, the company that is doing the acquisition would obviously pay a premium,
right?
And that would be reflected. It would be announced, and it would either be an all stock deal, an all cash deal, or a combination of cash and stock. So you would immediately see the company being acquired, that the announcement of that day, that equity or that stock the value would increase. It wouldn't trade right to the announced price because you have a fair amount of time between the time you make the announcement and get the deal done. At the same time, the company that was doing the acquisition, the acquirer, oftentimes their stock would go down because it would be increased expenses and the like. But what we're seeing, Harry, and I'm going to say more in 6 to 9 months or so, maybe even up to a year, oftentimes when that deal is announced, that both sides, the company, the acquirer and the acquiree, both sides end up moving higher. So it's a pretty interesting phenomena that we're in, but we seem to believe that this merger and acquisition, I don't want to call it a frenzy. That's not the right word.
But there is a lot of it.
The mode that we're in is going to continue for some time.
I think people take a look at what it means and how it's going to shake out, and that if it's good for both companies, there's no downside.
Yeah, and the big difference is that in 2007, a lot of this was done with leverage. Leveraging your balance sheet to the point, and some very, very unique, as I'll describe it, financial engineering to get it done. Now, because there's a lot of the companies have so much in cash, and the value of their underlying equity is higher than it was, 2, 3, 5 years ago. You're not taking on that same leverage to get these deals done.
Chuck, let me ask you, because I meant to bring this up when you were talking about Greece. This was reported in the last week, since we were last together, Chuck, that the Greece Prime Minister secretly tried to get a $10 billion loan from Russian President Vladimir Putin. The European Union, of course, didn't like it very much. I thought the intrigue around this, he had 2 secret meetings with him earlier in the year, and he was trying to cut his own side deal, is how I say it as a layperson. Pretty interesting.
Well, I think, Harry, in desperate times, people revert to desperate moves.
But that would have been a game changer if Putin had done it. That would have been a game changer.
Yeah, I'm not.
Greece would have cut a different deal, probably.
I think for sure there would have been a different deal, and I'm not quite certain that all of us would have liked the outcome. But that's again conjecture, and that's all. What the thought process is, because obviously they have a deal, they have to live by the deal, and the good news is that there's been obviously more discussion of late regarding the Chinese stock market, not so much about the economy, and everything that we're seeing in Greece so far. A lot of those headline. I remember the word headline risk, Harry, that we oftentimes talk about.
Yep.
We do know there's structural issues in both countries. There's no doubt about it. But investors at this point in time aren't focused for the most part on the day-to-day drama that was being developed, and I think a lot of it was being done, and it's particularly in Greece, with I don't want to call them your media friends because they're not, but folks in the media that created a fair amount of the drama. But we have to sleep with one eye open here because it's not as if these items went away. They're going to come back. They're going to resurface. And it's something we have to be very, very conscious of. There's no doubt about that.
Chuck, about 3 minutes in your program. Let me throw this out to you. You talk about, at the end of any given year, the importance of looking at where you are, if you have any tax liability, what you can do before the end of that year. That's always very, very good advice that you give out. Then you talk about the need for total asset management, proper asset allocation, and to look at what you're doing in the new year that's coming ahead. Now we are more than halfway through the year, 1/3 through the third quarter. Do you advise people to take a look at how they're doing in the current year and to see how things maybe in this year have changed as opposed to where they thought they might want to be at the beginning of the year now that the year is more than half over? What are your thoughts, generally speaking, about that?
Well, Harry, we had you oftentimes ask at the beginning of the year, where do you think we're going to be? And I think one of the comments that we made is that in 2015, we thought that high single digit, low double digits, particularly here in domestic equities. And as we got into the year, one of the things that we chatted about that is now certainly front and center is the fact that it seems as if a lot of international non-U.S. markets are doing much better, particularly Europe and Japan compared to the S&P 500. Now, with it, you need to look at. You always need, I think, Harry, depending upon your risk tolerance, you do need some international equities, and the question is, do you own a certain percentage? Do you own 10%? Do you own 20%? Do you own 30%? That is a decision that you need to your listeners need to talk with the respective advisors they work with to determine that percentage, because along with that, not only do you have risk in that market, that individual market, as evidence of what we're seeing in China, you have currency risk and you have potentially geopolitical risk. There hasn't been very much discussion of late with respect to geopolitical risk. It sort of has taken a back seat.
Why did it used to matter so much, and now it almost doesn't seem to matter at all? Is it because there is just so much of it that it is now accepted as, I hate this term, wrote a whole column about it in the Current Gazette a few years ago. Is this, quote unquote, the new normal? Don't you agree that, because we've been doing this 25 years, Chuck, geopolitical events used to be enormous and would do all kinds of things. Now it just seems like...
Yeah, and I think, Harry, you're right, because if you... And I don't want to take one event, but I will...
By the way, Chris Coleman, would you mark that tape, 8:44 and 3 seconds? Chuck Malamut said, Harry, you are right. I'll put that in a loop.
No, Harry, I say that a lot. You know that.
I know you do.
But
I couldn't resist.
But
sounded good.
If you take a look at the most recent market demise in the Chinese market, you would think if you're down 8% in one day before we even get to work, that the U.S. market would tank. And when you really understand what is happening sort of in China and what has propelled that market, the word geopolitical becomes very, very important, because government was obviously very, very active then and now trying to make that market. But we seem to have, sort of put that to the side, and we really need to focus on what is happening here.
Think about it, Chuck. Look what the markets are willing to just almost like water off a duck's back, almost ignore Greece, even though the markets did pay attention to it at the
Harry,
time.
No, that was not ignored. There was a lot, but there was a lot of volatility.
Okay, all right, I'll concede that point. Iran, all this other stuff that's going on, it just seems like the geopolitical issues just don't matter like they used to.
Harry, I don't think it doesn't. It's not as if it doesn't matter. I think the market has become somewhat of immune and is more accepting. Now, that's not to say if something blows up, so to speak, in the Far East, that we're not, or in the Middle East, we're not going to have a problem.
Well, look, Iraq did blow up, and the markets just yawned and ignored it. ISIS came of age. The markets have completely ignored it. I think my point is very, very firm, is very, very solid.
Harry, I think the one thing that we have to think about, and oftentimes the old expression, you have to sleep with one eye open. I don't care if you're starting to invest now or you've been an investor for your entire, lifetime. I would never, ever, put to aside the geopolitical risks. I think they have subsided somewhat, but I still think we need to be concerned, on a day-to-day basis to what happens around the world. Janice
Dean is on deck. This program is presented weekly by Chuck Malamut of Morgan Stanley's Northfield office. And the information, views, and opinions expressed on this program by Chuck are those of Chuck and do not necessarily reflect those of Morgan Stanley or its affiliates. They are current as of this date and are subject to change without notice. Neither the information provided nor any opinion expressed herein constitutes a solicitation for the purchase or sale of any security. This presentation is for informational purposes only. Morgan Stanley, Smith Barney, member SIPC. See you in 1 week.
Harry,
Chuck.
thanks for having me.
You know it.
Good
I'll
segment.
see you sooner than that, but we'll be back here on air in 1 week.
Early in the morning.
Thank you, sir. When we come back, if she is running on time, Janice Dean, Fox News All-Star. The Weather Machine, next.